Welcome to my crib.
I literally did this last time.
Well, this is my client Martin breaking into the house he just bought.
Oh my goodness.
And while a post-close break-in definitely makes this a memorable transaction, what makes it one for the record books is that Martin utilized a renovation loan to create $200,000 of equity.
You're putting 1.05 into a parcel that should be worth 1.25 when the work's done.
Correct.
That's the magic of the reno loan.
And I'm going to show you exactly how he did that. If you're a home buyer frustrated with the current state of the market, and let's face it, that's just about every buyer in this market, you need to understand how a renovation loan can help you achieve your homeownership dream and create equity in the process. So in this video, we'll start with the boring but important stuff, how renovation loans work and what programs you should utilize. Then we'll get to the exciting and more important stuff, the strategy behind a great reno loan purchase, in a segment I'm calling How to Create $200,000 of Equity in 5 Easy Steps. I should probably add that actual results will vary. $200,000 of equity is doable, and my clients Martin and Elle are doing it, but you need to be in an expensive market like Los Angeles to see such a big number. Still, I'm going to show you exactly what Martin and Elle did so that you can replicate it in your market. Sound good? Okay, before we dive in, I want to thank you for watching and for supporting what I do by hitting that thumbs up button. My name's John Schwartz. I'm a realtor and real estate investor in Los Angeles, California, and I help home buyers throughout the country compete and win in their competitive housing markets. If buying a home is in your future, subscribe for more videos like this one. So, first, we need to go over the mechanics of how a renovation loan, aka a reno loan, works. A reno loan is a specific loan product that finances both the purchase and renovation of a home. You take out a reno loan to both buy a fixer and fix it up. What's cool about reno loans is that the amount of money you can borrow is based on the value of the fully renovated finished product. So for example, a regular conventional loan allows you to borrow up to 95% of a home's purchase price. On a $300,000 home, you need to put down 5% or $15,000, and so long as you qualify, you can borrow up to 95% or $285,000. A reno loan works the same way, but instead of borrowing up to 95% of the home's purchase price, you can borrow up to 95% of the home's after repair value, also known as ARV. So let's say you find a fixer that's on the market for $200,000, but if it were fully renovated, it'd be worth $300,000. The reno loan then would be based on that ARV of $300,000. You'd put down 5%, $15,000, and borrow 95%, that is $285,000, to both buy the fixer and pay a general contractor to fully renovate it. This is valuable to you as a home buyer for 2 reasons. Firstly, those $200,000 fixers tend not to get as much attention as the $300,000 move-in ready homes. So if you're tired of losing bidding war after bidding war, going after some down market properties with a reno loan could be very fruitful. And secondly, and more importantly, the cost of renovating a home is typically less than the value created by executing the renovation. That's the entire premise of flipping houses. You usually create more value than you expend in renovating an old house. So in our example of a $200,000 home with an ARV of $300,000, it probably won't cost the full $100,000 to execute the renovation. It might cost only $80,000. So you wouldn't need a reno loan for $300,000, but just $280,000, the cost of the property plus the cost of the renovation. The down payment on this would be only $14,000, and in the end, you'd have put $280,000 into a property worth $300,000. So you would have created $20,000 of equity. And this is where strategy comes into play. By being strategic, not only can you finally buy a home, but you can maximize your equity creation in the process. Before we get into strategy, that is the 5 easy steps for creating $200,000 of equity. Actual results will vary. Let's briefly review the available reno loan programs. And keep in mind, I'm not a lender, so I'll probably get a few details wrong. Feel free to correct me in the comments if you are a lender, and if you're interested in utilizing a reno loan, you should definitely talk to a real lender first. There are 3 reno loans currently available: the Homestyle, the 203K, and the 203K Limited. The Homestyle loan is a conventional loan, whereas the 203K and the 203K Limited are FHA loans. So the Homestyle loan has the same borrowing limits, credit requirements, debt-to-income ratio guidelines, rates, etc. as a normal conventional loan. And the 203K and the 203K Limited have the same requirements, rates, and terms as a normal FHA loan. Homestyle requires a 5% down payment on a single-family home, 15% down on a duplex, and 25% down on a triplex or fourplex. I've seen advertising saying you can do a home style loan with 3% down, but I haven't actually encountered that myself, so talk to a lender and see what you can find out. The 203K and 203K Limited, like any FHA loan, allow for a minimum down payment of 3.5% on single-family and multifamily properties. With the home style and 203K, you can finance the first 6 months of mortgage payments, which means you won't have a payment to make until month 7. This is super valuable because the renovation will take a few months, and it can suck to pay a mortgage while also paying rent on where you live now. The 203K Limited does not allow you to finance any payments. The home style loan can be used for primary residences, second homes, and even investment properties, while the 203K and 203K Limited are only for owner-occupied homes. And lastly, the 203K Limited puts a cap of $35,000 on renovation costs. The 203K Limited is really for a home that is structurally sound, has all systems in place, but needs cosmetic updating. The 203K Limited caps your rental budget, but it's also a more streamlined process. However, with the home style and 203K, the rental funding has almost no restrictions. Redo walls and floors, install new bathrooms, redo the kitchen, add a second story, install central air. I haven't had the opportunity to test the outer limits of what Fannie Mae and the FHA will approve, but from my understanding, you can put rental funds toward basically any structural, livability, or health and safety improvement, including, and this is huge, including adding an ADU to a single-family home. Now, there are a few restrictions. As I understand it, you have to convert an existing detached structure, like a separate garage, into an ADU for the funding to be approved. But the bottom line is, a reno loan will finance a home purchase and ADU conversion in one. This is currently the only ADU financing that I'm aware of. So this is kind of a big deal.
Really?
All right, now let's talk strategy. It's time for how to create $200,000 of equity in 5 easy steps. Actual results will vary. Step 1. Find your property. Here's the thing. You will run yourself ragged if you take your reno loan and only offer on home run deals. Because in every market except the smallest and the slowest, there are professional flippers who will beat you with an all-cash offer and 7-day close. That's just the reality of the housing market we live in right now. But there's an inefficiency you can take advantage of, and it has to do with housing market psychology. On the one side, you have flippers who will make offers on any home without any regard for the asking price. Flippers work backward from the ARV, the post-renovation value that we discussed earlier, to come up with their price, and they'll offer that regardless of what the asking price is. And on the other side, you have certain sellers who won't entertain any offer below their asking price. If they have a reasonable asking price, there's no problem. But if their asking price is even a little higher than what the market brings, they won't sell. This is the opportunity you want to exploit as a reno loan buyer. You're not going to get the home run deals because they'll be priced low enough to attract flippers competing with cash offers. You want to find the doubles and the triples, homes that are just a little too expensive for the flippers, but require way too much work for the typical home buyer. And that's exactly what Martin and L did. They found a property that offered great views and appeared to need quite a bit of work. We went to the open house and it was dead. Only 3 or 4 parties had visited, which indicated that the asking price of $799,000 was enough to keep the horde of LA flippers away. We also discovered some potentially very serious foundation problems, which we knew would further deter flippers. Had the property been listed for $699 instead of $799, it would have been a very different story. Fortunately for us, it was listed a little too high to attract any cash offers at asking price. All right, step 2. Use sales comps to estimate an ARV. The big question when utilizing a rental loan is, will the ARV be high enough to fully cover the rental cost and ideally create some equity too? To answer this question, you need to find recent sales in the neighborhood that indicate what your subject property will be worth once it's freshly renovated. Fortunately for Martin and L, we had a perfect comp in the neighboring parcel. The house literally next door was a newly built 4-bedroom, 2.5 bathroom, 1,573 square foot home that sold in July 2020 for $900,000 or $572 per square foot. Martin and L's prospective purchase was a 3-bedroom, 1-bathroom, 866 square foot home. If we added a bedroom and bathroom and achieved the neighbor's price per square foot, we'd be looking at an ARV of $1,067,000. And we were doing this calculation in September 2021. So given the year of appreciation that had accrued, we expected Martin and L's home to attain an ARV closer to $1.15 million. So subtract the purchase price of $799,000 from the anticipated ARV of $1.15 million, and you're left with a reno budget of about $350,000. Looking at the home, it was clear that $350,000 was more than enough for a full renovation, with one exception, the foundation. The foundation was a massive wild card that we'd have to address in our next step. All right, step number 3, Write a clean offer, at least as clean as possible. A nice aspect of reno loans is that they allow you to write very clean offers. You don't really need an inspection contingency because any defects will be addressed by the renovation, and you can offer a full asking price because if you've found the right property, there will still be plenty of meat on the bone to create equity. In Martin & L's case, we had one wild card, the foundation. So I crafted as clean an offer as I could while still protecting my clients. Our offer had no contingencies and gave full asking price, $799,000, minus the cost to repair the foundation, as indicated by a professional foundation inspection to be conducted. I know this seems backwards because we weren't even offering a concrete price, but here's the thing. Some sellers fall in love with their asking price and are willing to compromise in order to achieve it. In this case, even though our offer didn't have a specific price, it got our feet in the door and kept us in play. Long story short, we ended up doing a foundation inspection, compromising on the repair cost, and going into contract at $750,000. The property had multiple cash offers at $750,000, but by starting our offer with the asking price, and by being clean, transparent, and amicable, we won the bidding. Which brings us to step number 4, get smart with your contractor. With a regular loan, when your offer gets accepted, the lender sends an appraiser to make sure the home is worth what you're paying. With a reno loan, the first step is having your contractor prepare a bid for the renovation. The bid outlines all of the work to be done and how much it will cost. Then an appraiser looks at the property and the bid together to determine the ARV. So the first step after your offer is accepted is to walk the property with your contractor and discuss the renovation. It looks like this.
Yeah, keep this.
Yeah, just keep the footprint and
New tub.
And to the extent that you can, you want to implement changes that will increase the value of the property. Adding square footage always adds value, as does adding bedrooms and bathrooms to existing square footage. Wooden porches and decks create big ROI, return on investment, and your contractor should help you scope the reno for maximum equity gain. You want to keep your finishes simple and put your money into expanding livability. In Martin & L's case, we're converting the garage into an additional bedroom, which has the added benefit of increasing the home's square footage. The result will be a 4-bedroom, 3-bathroom home, and the appraisal gave it an ARV of $1.25 million. As teased at the beginning of the video, total costs will be about $1.05 million, $750,000 for the purchase, and $300,000 for the renovation, including the foundation repair. And that's how you create $200,000 of equity with a reno loan. Well, actually, there's one more step, but before we get there, let's take a look at Martin & L's home just before renovation began. And we've covered a lot in this video, so much that it may even feel overwhelming or scary. So while we're touring the home, we'll listen to Martin's words of advice about how he feels in this moment.
So how do you feel at this point in the process? And I preface this by saying there are probably people watching this who think maybe I'll get into a reno loan and then visit some properties and see what a mess some properties can be and fear the terror that you must be feeling right now because you're at the start of the process. How do you feel?
I've been telling my fiance this. This is the worst part. So the condition is rough. We are planning to inhabit it. So it's kind of like, I wouldn't even call it glamping. Camping is kind of how we're approaching it. So, a little bit overwhelming, but great way to learn, and I think we're ready for the challenge. Obviously we see the upside in the property, so we just kind of have to do the thing at this point. So
Yeah.
So cautiously optimistic, but a little nervous, but that's the biggest transaction of my life to date, so I'm sure that's normal jitters, right?
And finally, step 5, renovate the place. Step 5 is, of course, the biggest step and will take months to complete. I have 2 pieces of good news. Firstly, all work completed as part of a reno loan must be completed by a licensed contractor. So yes, you'll have the headache of babysitting a renovation, but you'll have an experienced licensed contractor there to do all the work. And secondly, Martin & L have graciously invited me back to follow the renovation and document the finished product. Not only will we see the work as it's completed, but we haven't even begun to peel the onion on Martin & L's investment. The renovation is just phase 1. Phase 2 will be utilizing California's new law SB 9 to convert this single-family home into a duplex, and the current renovation is preparing the building for this use change. And then finally, also under SB 9, Martin is planning to subdivide the lot and build another duplex on the downhill portion facing the street below. If any of this sounds interesting to you, and all of it should, subscribe for videos covering the rest of Martin & L's story, amongst others, out every Tuesday. See you next week.